Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights, with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Welcome back to ETF Market Insights. I'm your host, Erin Allen, VP of Online Distribution with BMO ETFs. And today, as promised, we'll be doing a deep dive into the world of all-in-one covered call ETFs, and specifically into BMO's new ZWQT, the BMO Global Enhanced Income ETF, which is a fund that holds all of our covered call ETFs in one solution for you. We'll also review sort of the covered call ETF landscape as a whole and some things to consider when you're looking at the different methodologies available to you out there. So as always, we want you to do your due diligence when it comes to these products, and I think this episode today will help you with that. So as always, a quick reminder that we're not providing you any investment advice or investment recommendations in today's episode. As usual, it's all about providing education around ETFs and around investing for Canadian do-it-yourself investors. So today I have the pleasure of being joined by Karmalkar, Portfolio Manager on our Covered Call ETFs. Welcome back to the channel, Thanks for joining me.
Thanks for having me, Erin.
I'm also joined by Tony Dong, who is an author for many different financial or investing publications out there. You probably recognize him from his work with the Motley Fool here in Canada. Also writes for USA Today, the Neo ETF Market, Street, many, many more. Tony was on the channel a few months ago. We talked about asset allocation ETFs. So if you missed that one, I encourage you to check that one out as well. But thanks for joining me again, Tony. Welcome back.
My pleasure, Erin. Happy to be here.
Awesome. So let's get right into it and kick things off today. I think it's best to just start with a review sort of what the overall benefit of a covered call ETF is, and sort of a discussion around who this might be for or what needs these solutions meet. So Tony, I'll turn that one over to you.
Yeah, sure. So the way I like to think about covered call ETFs is that you're using an option strategy to convert potential future upside gains into an immediate cash premium. Now, the goal of these ETFs is to provide a consistent monthly cash flow that exceeds what you can receive from other income assets. For instance, the yield on a covered call ETF will often be higher than those from, say, a real estate investment trust fund, a dividend fund, preferred shares, or even high yield bonds. Now, these funds are generally suitable for investors who have the objective of needing a steady income stream. For instance, a common one are retirees who may need this to supplement their Canada pension plan, old age security, or withdrawals from a registered retirement income fund. These ETFs also may offer tax efficiency, as the income derived can be subject to capital gains tax instead of the higher income tax rate, which can result in greater tax efficiency. But of course, that all depends on your situation and the particular fund.
For sure, that's awesome. So really, it's all about the monthly cash flow, right? And if you need that, this is a solution that might help you get that higher level of enhanced income on your portfolio. We're going to get into all-in-one covered call ETF solutions, but first I think it's best to start and review how BMO's covered call strategy differs from others, because I think that's sort of what's going to make this all-in-one solution unique in the marketplace as well. So walk us through how we do it, how we balance that growth and income in the portfolio.
Yeah, for sure. I think for any covered call strategy, I think from a client perspective, it's very important to have that delicate balance between upside participation, but at the same time having that consistent monthly cash flows. So the way we do it at BMO is, we approach that problem on a three-step basis. First thing, what we do is we don't write call options on the full 100% of our portfolio. We only write it on the 50% of our portfolio. So you have 50% of the portfolio that has no call options on it. So it has full upside participation. And then 50% of the portfolio, you have the call options that you are writing to generate that monthly cash flow. Second, what we do is on the call option side, we actually write out of the money. And what I mean by out of the money is, for example, let's say BMO is trading at $100. we write 105 strike, so 105, so that's 5% out of the money. So that way what happens is if the market does go up during that time period, the portion that you have written the call options on, they also participate on that upside up to the strike price of that call option. So you're not giving up any upside or you're giving up a limited upside participation on those call side as well. And third thing we do is we actually diversify our options across different terms. And what I mean by that is, we don't put all our expiry on one particular day, so not expiring every third Friday. We try to diversify that risk. And what that helps with is, it gets rid of some of the pin risk that's there in the portfolio. Very simple example is, let's say there's earnings coming up for some company on Friday. You don't want all your options expiring on that day, because it could happen they have good earnings, stock rallies really fast on that particular day. But as market digests the information, reads more into it, maybe the next Monday the stock price comes down, but you got called away on Friday itself. So that's why having that approach of diversifying the different term for these call options also helps get that balance between upside participation and that monthly cash flow. So I think having this three-pronged approach in managing the solution gives us a bit of an edge in this space.
And we've talked about it before on the channel, just about how transparent we are in terms of our strategy. I think that sort of sets us apart as well.
Agreed.
So a lot on this channel, but we also have the piece that you help put out every month too, right?
Yeah, exactly. So in terms of transparency, we believe in showing what we are doing within the portfolio, and not just on the methodology. So you can go and see how we construct the portfolio from bottom up. So why we pick the stocks that we pick, what's our methodology there, that's all there on the website. But also from the option side, you can see what kind of out of the moneyness we have in terms of different ETFs. So if you want to look at banks, how much out of the moneyness do we have in the portfolio currently? When are the expiries for these options? How much income you're getting from the option side of the portfolio, how much income you're getting from the underlying stocks. So, having that kind of information out there helps the client make a much more informed decision in terms of if that portfolio is right for them.
Absolutely. Tony, walk us through, you do a great job at distilling sort of the overall marketplace. So what is out there in terms of covered call ETFs in Canada, and who's sort of gaining the lion's share of assets? Who are the biggest ETFs out there, if you will?
Absolutely. So this ETF niche is highly popular in Canada. Canadian investors have always been more income focused, I've found, compared to, say, US investors. I'm not sure why that is, but that's just the case here. So as of December 31st, 2022, we're looking at about 14 billion in assets under management for all the Canadian covered call ETF landscape. In terms of the largest provider, it does go to BMO, which dominates around 64% of market share by AUM. Following that is Harvest ETFs, which specializes in income products. And then, of course, you have CI Global Asset Management. Now, in terms of the largest funds we're looking at right now, it's all BMO products. So the largest one is the BMO Covered Call Canadian Banks ETFs, or ZWB. Then you have Covered Call Utilities, Canadian High Dividend, US High Dividend. So you really get a lot of unique sector and geographical representation. And I think that one of the reasons why the BMO lineup has been popular is that it's been able to offer specifically what investors want: targeted exposure to certain desirable asset classes, sectors, and geographies with, as Ohm described, a very transparent covered call strategy where investors can clearly see what they're getting, what the rationale is, and what the methodology is. And it's really underestimated how much investors want transparency, because you have some covered call ETF providers, I'm not going to name names, but they do things like they have very high return of capital, where they're just giving your money back to inflate that distribution. And that's not really what investors want, nor what should they be receiving.
For sure. And I think having what's helped BMO is our 10 plus year track record on some of our mandates too, right? Which leads me to my next question of trivia. Put you guys on the spot. What do you think the first covered call ETF in Canada was?
So the first one, so I know the first one was launched by BMO back in 2011, which was ZWB, which was the BMO Canadian Covered Call Bank ETF. And I think this just speaks to kind of, our, our communication with clients, because even back in 2011, that's how we got into the business, speaking with advisors and clients and understanding their needs. And that's where, this need for income and need for transparency was, created. And that's why, banks are very popular with Canadians. I think Canadian banks, if you don't have Canadian banks in your Canadian portfolio, something's wrong. So, I think this portfolio was created for that, where, clients wanted to have Canadian bank exposure, but also wanted to get additional income on top of what the Canadian bank dividend was at that time. So again, like you said, we have more than a decade worth of experience managing these covered call solutions, and we have the tacit knowledge of being able to balance that income, that growth, and being very transparent with clients on how we do what we do.
For sure. All right, so we recently launched ZWQT, our new all-in-one solution. So walk us through what this is giving investors exposure to.
Perfect. Yeah. So we recently launched ZWQT, which is our BMO Global Enhanced Income Fund. It is a ETF of ETF or fund of fund solution where we hold underlying BMO covered call solutions within ZWQT. This provides clients with a few things. So it is a one-ticket shop for clients, or one-ticket solution for clients who want that covered call exposure or want that income, but they don't know which ETFs to buy. So they have a one-stop solution where they're like, okay, this is paying me about 7% annualized yield, great, and I don't have to worry about asset allocation within the solution. So it's a great one-stop solution for clients. On top of it, you're getting the benefits of the covered call, like better tax treatment, lower volatility, steady income, but you're also getting in this product two new things. One, strategic asset allocation. So where when we design the product, we review it on a quarterly basis, but when we design it, we review how we want to position the portfolio over a 1 to 2 year period, where we see the markets, and that way, the way we create the weights within the portfolio. Yeah, it is a global strategy, so there are weights in European markets and global markets. Second, what we do is there's tactical asset allocation. So clients also get tactical asset allocation available within this product. We do this on a monthly basis. We work very closely with our multi-asset team, where we take their inputs into our decision-making process. And this provides clients with that ability, gives us the ability to move in and out at a much faster pace compared to a client who might not have as much time in moving from, for example, tech space to utility or utility to tech, depending on what the market is saying. So it gives us the opportunity to take advantage of different market scenarios. And we are in a market environment where it's very data driven, and it can change very quickly. So it's very important to be a bit more nimble in this environment. And and finally I would say is we don't, because we hold underlying BMO covered calls, we don't charge any fees on the underlying holdings. So we only charge one fee at the top level, and we don't charge anything for the underlying holdings. Finally, I would just say, yeah, it is a great product. I am excited for this launch because it gives clients a new avenue to be able to get in the covered call space without having too much, stress or thinking like, do I want this much US? Do I want this much Canada? Am I bullish Canadian banks? So, this gives them a one-ticket solution where you can invest, get your monthly income, and know that you have that strategic asset allocation plus tactical asset allocation within the ETF fund.
Yeah, and I think we waited so long to launch this because we wanted to make sure we had all of those underlying building blocks. And now that we have them, putting them to use in this portfolio is really efficient for clients because, as you said, you're not getting charged twice. We're not investing in other people's covered call ETFs. It's all within that 65 basis point management fee. So I should highlight
exactly.
That. The distribution yield, only an estimate at this point because it hasn't paid out its first distribution, but based off of the underlying portfolio, it's just under 7%, right, Om?
Correct. Yeah, it's just under 7. It's just, yeah.
And that's a monthly distribution, just like all of our other covered call ETFs as well.
Correct.
Tony, how does this all-in-one ETF compare to some of the other fund of fund solutions out there that are on your radar?
Yeah, so the number one thing I see is that ZWQT's underlying geographical distribution roughly mirrors what we currently see from a market cap weighted equity portfolio. So you have US stocks sitting at around 59%, which is in line with what the world is currently at. And then the rest of it is comprised of developed markets. What I'm looking at right now is a 22% overweight to Canadian equities, which we know is beneficial for Canadian investors. It's called a home country bias. And historically, it's reduced currency volatility, it's reduced overall portfolio volatility, and it's greatly improved tax efficiency. The other thing I see compared to many covered call ETFs that have the word enhanced in their names is a lack of leverage. You see some covered call ETFs that will deploy around 25% cash leverage or 1.25 times. Of course, this can enhance your gains, but it can also enhance downside risk. And whenever leverage comes into the equation, I would always suggest that investors look cautiously and decide if that's really for them. Ohm did note that ZWQT does not double dip on funds, so it's not like charging the expense ratios of the underlying and then a second one at the ETFs levels. It's just one complete one complete expense ratio. You don't have to worry about extra fees. And I think the thing that I'm really interested in is that not only does it hold geographical representation from around the world, like Ohm says, it's able to tactically overweight certain sectors. So right now I'm seeing that it has extra allocations to technology, which is great because of the high volatility we're seeing there right now. It's going to mean higher options premiums. Of course, there's an overweight to Canadian banks. I'm also seeing some energy and some US banks as well. So I think it's just, instead of managing 10 different covered call positions on my own, trying to rebalance this position as an advisor, you could simply buy something like this, be confident in the 7% annualized distribution, be happy with the monthly premiums, and just not have to worry about it. It just gives you more time to worry about the actual things that matter when you're running a practice and looking for income.
Well, you hit my next question for you there around why buy the ETF over do it yourself, but I think that's exactly right. It's the time saving, the cost efficiency, and the know-how, right? Like we have professional team managing these, which is huge benefit.
I would also put in a point about capital efficiency. You think about implementing a covered call strategy on your own. Let's say if I wanted to do just a very simple one on the S&P 500, right? The most popular ETF for that SPY currently trades at around, I don't know the price off my head, but it's around $400 a share, right? You need 100 shares to simply sell one call. That's very capital inefficient. You need around $40,000 US simply to do that. You got to manually write the calls. You got to roll them over. You got to monitor yourself. If earning calls comes up, right, you got to watch for changes in implied volatility, theta, all these different options Greeks that let's be fair, the average advisor with enough assets under management does not have time to go through each client portfolio doing this. So I think it's worth paying the 65 basis points to leave it to an advisor to select the strikes, stagger the expiry dates, right? Build that strategy. And as long as it's transparent, that they're out of the money, how much they're out of the money, what the expiries are, what the underlying is. That's very important. I'd be happy to pay that fee if this was a strategy that myself or my clients were looking for, simply just from capital efficiency and a convenience perspective.
And then not to mention the size of BMO asset management option book, I guess maybe you can touch on the efficiencies that creates as well from a cost perspective.
Yeah, for sure. So, we are one of the biggest option traders in Canada. And, on the Canadian marketplace, trading options in big sizes can be inefficient if you're doing it from your own site and you don't have those institutional relationships. So best example is, if you want to trade a few thousand contracts on any of the banks, you need to have those relationships, or, we call it the upstairs market, where, you need to have those institutional relationships to be able to get that trade done without having a negative market impact, right? So Canadian market space is very unique in that sense, where having those relationships matter to be able to trade those big amounts. And sometimes, one of the other benefits is sometimes, let's say a stock is trading at 58, right? It doesn't matter what stock, but let's say it's trading at 58. You want to do a strike of 60.5, but it's not listed right now on the market. as being one of the biggest, we are able to get that listed on the TSX exchange and be able to trade that. So we are able to create strikes that the average investor might not be able to get exposure to. So those are some other benefits, of going down the path of covered call solutions.
Mm-hmm. All right, and then sort of to wrap up, what are the things that investors should be really looking at or doing their due diligence around, or potential risks associated with covered call ETFs that investors should be thinking about?
Sure. I think there are two. And the first one obviously is the capped upside. Now, BMO does try to mitigate this as much as possible by just limiting the covered call overlay to 50% of the portfolio. But you got to realize that in a sustained low volatility bull market, you are going to trail a long only index fund. And that's just mathematically how covered calls work. You're consciously foregoing a portion of your upside returns for an immediate cash premium. So if you don't need that income, these products might not be right for you, right? These are built for people who need that consistent distribution every single month to withdraw and spend on something. So if you're just reinvesting it to snowball, which is a common misconception I see, it's not really going to be the right product for you. The other thing you got to watch out for is that, yes, while the premium received from these products can provide a measure of downside protection and volatility reduction, it's not a true hedge. In a sharp enough crash, right, the downsides of these products are similar to a long only equity strategy. When it comes to really protecting the downside, your options, no pun intended, are limited to buying puts or, like buying something like volatility futures, which introduces a whole new realm of complexity. So once again, understand that yes, you get some downside protection, but really the downside risk of a equity position is still very much present with these products.
Yeah, I'll just add to that. I totally agree with Tony on the points he made. It tends to be an equity-based strategy. So you are taking on that equity risk. So, clients and advisors should be aware of that. At the end of the day, it is an equity strategy with the option strategy overlay on top of it. Another thing I would say is, be careful with fees. And what I mean by that is there's kind of management fees of 65 basis points that, listed on the product, but you should kind of look at the total management expense ratio at the on a quarterly basis or, at the end of the year to see what the true cost of managing that portfolio was. Because there are times where, management expense might be 65 basis points. But if you look at kind of the total management expense ratio, it's, north of 1%, north of 2%. So I always say, before you invest in any underlying ETF, you should always look at like the fact sheet. These are kind of audited, so, and look at what the actual total expenses that you are actually paying.
Yeah, I would add two more things to that. The first one is really understand where your yield is coming from, right? BMO is very good with that because you can see exactly what portion are from the options premiums and what portion are from the underlying dividends collected. But some other ETF providers are a bit more opaque. So you might see something really cool like, oh my God, this covered call ETF has a 10% annualized distribution. But if you look really closely in their documents, a good portion of that is return of capital, which is a fancy way of the fund manager taking the money you invested and just returning it back to you as a distribution, right? That's obviously not beneficial. So you want to really look out for that. And the last thing I would impart on people buying these funds is that don't chase yields, right? The yield can be important if you're looking for a consistent level of income, but the most important thing, in my opinion, is looking at the underlying portfolio. What exactly does this ETF have exposure to? Is it sufficiently diversified across geographies, sectors, different strategies? How's the covered call overlay actually implemented, right? Figuring out the fundamentals first and then looking at yield will probably set you up for success more than doing the opposite. And I think that's where ZWQT really shines because it is already globally diversified across both geography and sectors.
Perfect. Couldn't have said it better myself. Thank you guys. That was great. I enjoyed the discussion. Wish we had longer, but hope our viewers found it insightful. We have been receiving a lot of questions on ZWQT, so I hope this provides that deeper level of knowledge in terms of this new solution. And I hope to have you back, both back on again soon.
Perfect. Thanks, Erin.
Okay.
Thanks, Erin. It was great.
That caps off another great week of ETF Market Insights. Next week, I'll be joined by ARK Invest. We'll be discussing the latest and hottest topic of artificial intelligence. I'll be joined by a couple of ARC's research analysts who are going to be digging into some of the groundbreaking innovations coming out of this space. So Frank Downing and William Summerlin will be on the channel, so I hope you'll join us then. It should be a good one. Thanks again for joining us, and we'll see you next time. Bye for now.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.